So now today my primary purpose is basically, after having discussed what has recently happened in the global and the Turkish economy, looking at some data and maybe even we have looked at some forecasts. Now today my purpose is now to start a discussion with respect to this flagship publications of two very important international institutions. One of them is the IMF, the other one is the World Bank. I mean, I'm sure you have heard about these institutions before. I mean, there are some additional institutions as well, in addition to the IMF and the World Bank, that are, so to speak, overseeing or regulating the global economy. I mean, IMF's main purpose was actually, when it was founded in 1947, it was basically overseeing the Bretton Woods system. I mean, you must have heard about that before in previous courses, maybe in EC 208 as well, in Open Economy Macro. But basically, the IMF's main function was being the police of the or the regulator of the Bretton Woods system. I mean, the gold exchange standard system, where the value of the US dollar was tied to gold, and then all other currencies, including Turkish lira, was pegged to the US dollar. But then, I mean, of course, from time to time, economies needed devaluations, in the sense that, I mean, if they give huge current account deficits, maybe, for example, due to the fact that they give inflation above and beyond other countries, then your products are becoming more expensive with the fixed exchange rate. So the exchange rate does not depreciate. Your nominal your local currency does not depreciate, but your prices are going up, means that your prices are also going up in other currencies, and therefore other countries will not be buying products from you because your products become more expensive, and then you start to give trade deficit, and therefore a current account deficit. Therefore, you can go into a balance of payment crisis. So IMF was there basically so that the countries did not experience this type of economic crisis. And if they experience such crisis, then IMF's function was helping them to go out of the crisis. And then it allowed, for example, there was what we call the IMF conditionality. I don't know whether you have heard about the term. IMF conditionality was referring to the fact that in order to depreciate your currency, because you are giving a huge trade deficit and current account deficit, you have to get approval from the IMF. And the IMF approval comes with a bunch of conditions so that this doesn't happen again. In Turkey, it happened in 1958. It happened in 1970. Turkish lira was depreciated against all other currencies of the Bretton Woods system in a major way in those 2 years. But then once the Bretton Woods system collapsed, IMF became more like an, I mean, global advisory institution to governments. And of course, it also I mean, if governments, if countries, economies go into economic crisis, economic distress, then there was always this option of getting help from the IMF. It could be in the form of IMF loan or IMF advice. IMF has a country desk for every member country. I mean, and almost all countries in the world, I mean, except a few are members of the IMF. And for every member country, there is a desk. I mean, when I say a desk, I'm not referring to a physical desk. I mean, a desk is a unit. Okay? Yani ülke masası, Türkiye masası vardır hatta, Türkiye masası şefi, the chief of the Turkish desk. I mean, it's basically depending on the size of the country, it employs, every desk employs a few economists. I mean, of course, the larger the size of the country, the larger the desk. And sometimes also, if the country has a structural adjustment program agreement with the IMF, I mean, if a government is actively currently getting a loan from the IMF and IMF is administrating a program there, of course, then the desk gets larger. But otherwise, every country has a desk. And that desk is responsible for reporting the evolution of the economy in those countries. Okay, so, and that task, again, could be very powerful. I remember, for example, when I was a kid, I mean, not a kid, maybe a high school student in 2000, I mean, in this 2000-2001 crisis, or after the 2000-2001 crisis, I remember the Turkish chief was at that time Paolo Cottarelli, an Italian economist who was visiting Turkey very frequently during those difficult years. Um, but anyway, so this is what the IMF does. Actually, I mean, if you towards the middle of the semester, I will also be spending some time to discuss my own papers. Actually, a very recent paper of mine, if you are wondering, here is you can look at. Let me just. It's an open source, open access paper. You can access the paper from any you don't have to be in the university within the university's network to access the paper. It's a paper that we have published with a close friend of mine, Adem Yavuzel, where so the title of the paper is the the IMF standby agreements and inequality, the role of informality. So here, for example, we look at several countries have gone through, I mean, they have signed a standby agreement. Standby agreement is one type of the agreement that you can sign with the IMF. There is another one, Structural Adjustment Program, SAP. I mean, there are different agreements. I mean, it's not just one way for the IMF to support countries. Here, actually, we discuss it. The standby agreements represent the most prevalent efforts suggested by the IMF to assist nations in addressing their immediate balance of payment challenges, typically spanning 1 to 2 years. These programs, backed by substantial IMF resources, exert an influence on domestic institutions due to their reliance on the implementation of specific policy reforms. And here actually we document how many times countries have experienced such programs. Let me see. Maybe I have a data here. Stand by dummy. So yes, I mean 6% of the time. So it's a very large data set from, let me see, 1950 to 2018. So out of 59 countries, so it's, I mean, how many years? Maybe more than 60 years, definitely. And 160 countries, it's a huge data set with maybe 9,000, close to 10,000 observations, let's say. And out of these, so 10,000 country year units. And apparently 6% of all these years, so there are 10,000 years for all these countries actually that they could go through in that period in total. And 6% of the time, one country was in a standby agreement. It's significant. And then we look at basically what happens through a standby agreement before and after. Okay. I mean, I'm not going to go into the details of the paper right now. We can discuss it maybe later if time permits. But I just showed this to you that we know, like right now, we have a data set publicly, freely available online, where you can see what country in what year was in a standby agreement, for example, with the IMF. Anyway, but then, I mean, so as you can see, after the Bretton Woods Agreement, the role of the IMF has changed a little bit, but still it gives loans countries that go through balance of payment crisis. It gives loans to countries which go through fiscal crisis, exchange rate crisis, and it also has an advisory role. World Bank, on the other hand, is a different thing. I mean, World Bank is a bank. What does a bank do? I mean, a normal bank, a private bank, I mean, collects deposits and gives loans, right? I mean, in the case of World Bank, they do not collect deposits. I mean, they get the money from the mainly developed countries, but also from all the member countries, actually. And then they give loans to governments or to big firms. And mainly for infrastructure and or development related projects. Okay, like for example, those of you from Izmir may know that there is this famous İzban, right, that connects Ali Ağa to the airport of Izmir. I don't know where else it goes to, but it's a long tram line basically that has been almost fully, I mean, if not fully, partially, but I mean, the fraction is quite high, was financed by World Bank money. I mean, World Bank has regional subsidiary banks as well. Like for example, Asian Development Bank is for country. I mean, it's an arm of the World Bank that finances governments of Asian governments, the countries, the Asian countries. For Europe, where we are part of, we are also a member of the Asian Development Bank, by the way. But primarily, we get the funding from what we call EBRD. It's the European arm of the World Bank. It's called European Bank for Reconstruction and Development. It's headquartered in London. Asian Development Bank is headquartered in Manila, in the capital of Philippines. EBRD is headquartered in London, in the capital of United Kingdom. And EBRD, for example, has financed ISBAN, whatever. I mean, they also gave money for different infrastructures in the renovation and rehabilitation of some ports. I mean, they also gave some money for the healthcare system, etc., etc. I mean, so they give money for those kind of infrastructure or big government projects. And of course, they get it back. I mean, it's not a grant; it's a loan. Sometimes they can give small grants, but mainly it's a loan. But World Bank also, since it is more a development-oriented institution, IMF is more financially oriented institution. But the World Bank is more a development-related organization. Therefore, World Bank also employs economists, and World Bank also has country desks. But more than economists, World Bank employs anthropologists, sociologists, engineers. I mean, because they are also very much needed to do some development-related analysis. And both institutions, by the way, both the IMF and the World Bank, in addition to country desks, in addition to various different units, they also have a very large research department. The IMF's research department is very reputable, especially among the economics academia. It is hard to get in even as an economist. I mean, hard to get an offer to work there. And I mean, it primarily employs economists. I have several friends working there. And the World Bank has also a research department, but more than economists, it employs other social science scientists, or sometimes even engineers. It's somewhat less reputable among economics academia, to be honest. Anyway, so this is that, and so then when now coming to the flagship publications, as I have told you before, the World Bank, the IMF's flagship publications are, the flagship publication is, there is just one, World Economic Outlook, WEO. And as I said, it is always published in October and April. So you see, for example, the April 2024 issue, and then the October 2024 issue. This is called World Economic Outlook, October 2024. World Economic Outlook, April 2024. But as an interim report in between the two main reports, they also publish an update. One in July, but it's not called World Economic Outlook, it's called World Economic Outlook Update. A slight the difference in the name, July 2024. And then there is another update in January, World Economic Outlook Update, January 2025. Now, we are going to look at the reports, but first of all, before the reports, even the titles, because every report has a title, the title, even the title is important. I mean, it's, of course, IMF makes mistakes, by the way. I mean, IMF's forecasts are just forecasts. I mean, they also sometimes are not realized, that they are not very much in line with the actual realizations of the data. I mean, sometimes they do growth forecasts. You'll see in the report, they have growth forecasts, they have inflation forecasts for every member country. And of course, I mean, sometimes they are bad forecasts, okay? Or sometimes they do mistakes. But even if it's not a mistake, I mean, it's just a forecast. It does not have to, I mean, it is not necessarily equal to the actual realization of the whatever variable they are forecasting. Anyway, so let's look at the last few reports, maybe the titles of the report. So at least in this page. So October 2022, for example, when inflation was peaking in not only developing countries like Turkey, but also in developed countries, like, for example, US had a close to 9% inflation. İşte, the Eurozone has close to 10% inflation. So the title of the report is, as you can see, countering the cost of living crisis. Cost of living crisis is basically inflation due to inflation. There is a cost of living crisis. I mean, the cost of living is going up. And even in January 2023, when they published the update, then they called it inflation peaking amid low growth. So inflation plus low growth, stagflation, right? As economists, we love giving names to different episodes, different events. So you know the term stagflation. The low growth, more or less stagnation, and inflation peaking. And then April 2023, the actual report now, full report, a rocky recovery from this low growth, high inflation environment. But it is rocky, whatever that means. I mean, it means, of course, and it's a turbulent recovery. Then in July, they said near-term resilience, persistent challenges. Then in 2023 October, they called it navigating global divergences. Global divergences. Global divergences referring to, I mean, different countries performing differently. I mean, they do not converge to the same path in terms of growth path or in terms of inflation path. Then January 2024, last year, the beginning of last year, moderating inflation and steady growth open path to soft landing. So, I mean, soft landing is, I mean, the reduction in the inflation is going to be soft because, I mean, you can reduce the inflation with a very hard landing. Hard landing means like a crash. So that is possible. Soft landing means, no, there is no crash. So you are just landing the plane safely in a soft way. Then we have the April report last year, steady but slow, resilience amid divergence. Then the July update, global economy in a sticky spot. Then, so for example, sticky service inflation is holding up progress on disinflation. So inflation is, or the prices are sticky. I mean, sticky in the sense that the price increases are sticky, so to speak. Inflation is not going down as much as expected, as much as wished. And there is upside risk to inflation have increased, blah, blah, blah. Then October report last year, the last full report is policy pivot, rising threats. And so, I mean, we can just, I mean, we will look at the report, the latest report stable, but reports stable and underwhelming global growth with the balance of risk tilted to downside. As a monetary policy is eased amid continued disinflation, shifting gears is needed to ensure that fiscal policy is on a sustainable path and to rebuild fiscal buffers. And then finally, the January update, global growth, divergent and uncertain. It is 3.3%, but divergent and uncertain. So in different countries, there are different expectations. Now, let's look at this report first, the full report, because the full report you'll see, it contains country by country. No, thanks. So country by country forecasts. And when they announce the report, we can see it in April together. When they announced the April report, we can listen to their presentations of the reports, etc., etc. But the head of the research department is Pierre Olivier, this French guy, Pierre Olivier Gourinchas, whatever. So PhD from MIT, a very reputable person. And I mean, he is the one directing the research department, and the research department is the one that is producing this report. And I mean, we can look at the full report, but what they do is that actually, I mean, generally they announce a date for the publication of the report. So they say, for example, okay, on 15th of April, we'll announce the full report. But then 1 week before, they only post one of the chapters of the report. one of the selected chapters. Sometimes they have 3 chapters, sometimes they have 4, which I have seen in the past. They had as long as 5 chapters in one report, but generally 3 to 4 chapters. And actually, we can look at the full report now. Just a second. Here you can see it now. This is the full report. Let me just make it smaller. Just to see the structure of the report. So it has 3 chapters. One of them is global prospects and policy. So they just talk about the paths in the next few years. And great tightening, insights from recent inflation episodes, how they have reduced inflation in many countries. I mean, they look at, for example, lessons from monetary policy, the role of central bank balance sheet policies, the role of price suppressing policies, whether they were useful, whether they were effective, at what cost. And then understanding the social acceptability of structural reforms. So, I mean, social acceptability, because generally when we hear the word reform, we always get frightened, right? Because reform means cut in education spending, cuts in healthcare spending, government getting smaller, and therefore maybe subsidizing less products. And right, that government is, in a sense, withdrawing from the economy. That is generally what they are referring to with a reform. And of course, this creates social tensions. And I mean, therefore, how can you make these reforms? What if they are reforms, of course. Whether they are reforms is another story, but if they are reforms, how can you make them more acceptable in a social way? But then, I mean, so you can read the chapters, and actually I can give you some reading reports to read the chapters. But before that, one thing that I want to show you, always at the end of the full reports, they always have this large tables, which basically give you forecasts. So for example, this is GDP forecast table, summary of world output. I mean, GDP, real GDP. Now here, this is just categorizing regions or in major countries, the United States, Euro area, Japan, other advanced economies, etc., etc. And then there are a bunch of groups of countries like Middle East and North Africa, low-income developing countries, Sub-Saharan Africa, I mean, fuel exporting countries, etc., etc. But then they also have this data country by country. Like, for example, I'm sure we can find Turkey somewhere. So Germany, for example, let's say, is expected to grow in 2024 at 0%. No growth. So 0.8 in 2025, 0.7 in 2029. Then some quarterly projections are also given here. This is the Euro area. I mean, we have Sweden here. Let's see. I mean, for example, Sweden, I mean, their forecasts are also not very good, actually. I mean, country by country, the forecast could be really very bad. I mean, for very small countries, of course, I mean, they can really be growing at very extremely high or extremely low rates when something happens. Like when tourism declines, their GDP is reduced by half. In the boom, they recover very fast. So this is what happens, for example, in the special autonomous region of Macau, which is part of China. Turkey should be somewhere here. Let's see, advanced economies. Yes, here, Turkey. This is the GDP. This is the Turkey. Now, officially, we call it Turkey. So 5.1 for 2023. Okay, that's also realized. And they expect 3% for 2024 and 2.7% for 2025. I mean, this is very interesting because, for example, the Turkish government is more or less expecting that the growth is going to go up from 2024 to 2025. I mean, the expectation, I think, is 3.5% for 2025, if I remember correctly. And it is more than the expected growth from 2024. But IMF is thinking differently, apparently. They expect the growth to go down, not up. We'll see which one is going to be true. But I mean, so expectations can differ, as you can see. Um, what else? I mean, we have this, and then we also have, I think, inflation forecast. So this is GDP growth forecast. So for every country, you see, even for Zimbabwe, I mean, Sao Tome and Principe, whatever. And then inflation comes, summary of inflation. Advanced economies, they start with, again, then bunch of rich countries or bunch of poor countries. I mean, some regions, different regions. Then they go to country by country, consumer price changes. So this is the euro area. This is what they have for the euro area. Then Turkey is, see here. So in Turkey, 2024 forecast was 60.9. Now this is interesting because it was a projection that they made in October, 60.9. It turned out to be 45, right? Or 44.8 even. I mean, slightly less than 45, I guess, was the Turkish inflation in total. Of course, whether Turkish inflation is measured correctly or not is another matter. But IMF's forecast a few months before the year ended was 60.9. But it was not 60.9, it was 44. I mean, at least the one that is announced by Turkstat, which is quite different. And for the next year, or for this year actually now, for 2025, I mean, it was next year when they made the forecast, but they were expecting 33%. And now, I mean, I don't know. I think the expectations actually, we have seen that it's upper 20s, right? I mean, we expect something in between 25 to 30%. I mean, of course, households expect more, businesses expect more, but the market participants, they expect in between 25 to 30% now. So that is what it is. Yes. So what else? And they also have some forecasts related to, I mean, fiscal balances. This is not country by country though. This is only for major economies. They are reporting general government fiscal balances and debts. Summary of world trade volumes. Summary of world trade volumes continued. Summary of current account balances. Here, bunch of country groups. Then current account balance projections or realizations. I think for that we have country by country. For Turkey, for example, here they expect a reduction in the current account balance due to low growth primarily. What else? Summary of financial account balances, again for some selected economies, not for every economy. Yeah, I mean, so that's, I mean, in that sense, a very useful data source, to be honest. Of course, again, for realized data, so this shaded area are realized data. So this is now, there is no disagreement about that, but when it comes to forecasts, it's a forecast. Yeah, that's about that. I mean, this was the full report. I will give you the first reading report next week, and I think I can assign a chapter either from the last report or from this January update. Let's also look at the January update here. You'll see in the January update, the data at the end of the update is less substantial. Let's look at the full report and then we'll see why this is the case. This is the update report. It's very short, you see. I mean, the full report was, how many pages? It was 174 pages. The update is only 11 pages. So very short update. I mean, it's not a very full report, very lengthy report. I mean, some short description, and then they just provide some summary statistics, not for every country, only for the major economies. And I mean, US, Germany, France, Italy, Spain, Japan, UK, Canada, and then some country groups. That's it. And then, they even have an next table. Okay, for some selected countries, again, not for the full world. They have GDP growth projections. Okay, so Turkey, for example, let's see. Their projections from for 2000, so this is good. So because the projections for 2025, for example, now it was 2.7, remember? Now they made it 2.6, even less. And they even say that, I mean, we reduced it by 0.1 percentage point. And the 2026, they didn't change. But again, I mean, it's very interesting. So they are sticking to their projections because the Turkish government expects the GDP growth to go up with the loosening of monetary policy in 2025. On the contrary, the IMF expects the Turkish GDP growth to go down. And actually, they insisted in their initial, they even made it worse. I mean, not very significantly, but 0.1%. It's not very high number, but still, I mean, they haven't updated it in the. I mean, they didn't increase it. They didn't increase their expectations, but they instead even made it slightly worse, which is interesting. And also, I mean, you can go to the YouTube to press briefing. So this is the Pierre Olivier. And here, I mean, for the January update, we have the talk by Pierre Olivier, Petya Koeva, Deniz İgan, and Jose Luis de Haro. Deniz İgan is a Turkish economist, actually one of the, I mean, I know her, excellent person. Maybe even we can look at their updates, so we can just watch it. Since we have an online lecture, I mean, again, I want this lecture to be light. So let's don't go to the world development in global economic prospects, but let's also look at it. I mean, we are not going to watch the whole video, but still, I mean, I can also share the link with you here. We can just check what they are talking about. Let's also have
Happy New Year and welcome. I'm Jose Luis de Haro with the Communications Department.
Let's watch, I mean, a little bit, maybe 15 to 20 minutes, not the whole video, but a little bit, just to see what they are talking about.
Here at the IMF, and we are gathered here today for the launch of the World Economic Outlook Update. I hope that all of you have already accessed the latest edition of the World Economic Outlook Update. If not, I would recommend everyone to go to imf.org, and there you're gonna find the flagship, but you're also gonna find Pierre Olivier's blog and many other assets that we hope are gonna be helpful for your reporting. And also, let me remind you, for those who are not familiar with the World Economic Outlook cycle, that we are launching today an update. That means that not all the data for every country member, it's in that document. We only have numbers for a limited set of countries. So please keep that in mind. And I will remind you that basically we will have a full World Economic Outlook published in April during our spring meetings. But what's best that to talk a little bit of the content of this update, that to be joined here today by Pierre Olivier Gouvinches. He is the economic counselor, he's the chief economist, and also the director of the research department. And we are also joined by Deniz İgan. She is a division chief with the research department. As usual, Pierre Olivier is going to start with some opening remarks, and then we're going to proceed to take your questions. I want to remind everybody that this press briefing, it's on the record, it's virtual. We will be going to reporters that are joining us on WebEx, and I will be also posing questions that we already received through our press center. And within further ado, Pierre Olivier, the floor is yours.
Thank you, Jose, and good morning, everyone. In our latest projections, global growth remains steady at 3.3% this year and next, broadly aligned with world potential growth. Inflation is declining to 4.2% this year and 3.5% next year in a return to central bank targets. This means that the very large global disruptions that started with the pandemic, the war in Ukraine, and triggered the largest inflation surge in 40 years are behind us. This is the end of a cycle and the beginning of a new one. While the global outlook is broadly unchanged from October, divergences are widening. Among advanced economies, the United States is stronger than previously projected, expected to grow at 2.7% this year. By contrast, growth in the euro area is revised downwards and will increase only modestly to 1% in 2025, reflecting low consumer confidence and the persistence of high energy prices, especially relative to the United States. Elevated trade policy uncertainty will contribute to anemic demand in many countries, including China, where we project 4.6% growth this year. Some of the divergence is structural. For instance, the US experienced persistently stronger productivity growth than Europe, especially in the technology sector, linked to a favorable business environment and deeper capital markets. Among emerging economies, potential growth has decreased for China, in line with secular and demographic trends, but it has increased in other emerging markets, and the two are now comparable. Turning to the risks, economic policy uncertainty is elevated, with likely policy shifts from many newly elected governments in 2024. In the near term, risks could exacerbate divergences between countries. The euro area could slow down more than anticipated due to weak momentum in manufacturing and fiscal vulnerabilities in some countries. For China, the risks are also to the downside. The economy is at risk of a debt deflation trap, and the decline in Chinese government bond yields shows rising investor concern. Both for the euro area and China, this could lower activity and inflation. For the US, many of the uncertainties originate with potential policy shifts under the new US administration. While these are hard to quantify precisely at this stage, we would categorize them as follows. First, there are demand-stimulating risks, such as a further fiscal stimulus or a confidence boom fueled by expected deregulation efforts. These would increase output and inflation in the near term. There are also supply-constraining risks, such as higher tariffs or curbs on migration. These would weigh on output, but also add to price pressures. The combined effect on output in the near term is uncertain, but likely to the upside in our assessment. Any combination of these policies, on the other hand, is likely to add to price pressures in the US. Higher inflation would prevent the Federal Reserve from cutting interest rates as initially planned. These policies will also likely strengthen the dollar and tighten financial conditions elsewhere, especially for emerging market and developing economies. In the medium term, the risks are more uniformly to the downside. Curbs on migration and protectionist policies will weigh on potential output. The initial positive effect of a fiscal expansion will wane, and the associated increase in public debt could lead to fiscal vulnerabilities further down the road. The increase in US long-term yields, despite the Federal Reserve easing, reflects some market nervousness about future fiscal policies. Deregulation could boost output by removing red tape and spurring innovation, but it could also increase financial vulnerabilities. Another risk is that renewed inflation pressures so soon after the recent episode could de-anchor inflation expectations as people and businesses have become much more vigilant. Indeed, we see that near-term inflation expectations have increased above central bank targets. Turning to policies, given this environment, central banks should remain vigilant and be ready to act forcefully if inflation were to break out again, while also monitoring carefully the buildup in financial risks. Second, fiscal buffers need to be restored now, and countries need to do so in a way that preserves growth. As history teaches us, delaying needed adjustments in a low-growth, high-interest rates environment can trigger market loss of confidence that would further add to fiscal pressures. In addition, countries should continue to seek ways to improve growth by focusing their efforts on ambitious structural reforms that will help better allocate resources, increase government revenues, foster innovation and competition. On that front, it is also important to preserve and improve our multilateral institutions to help unlock a richer, more resilient, and sustainable global economy. Thank you.
Thank you, Pierre-Olivier. And before I open the floor to all your questions, some ground rules, 3 main points. The first one, if you want to ask a question, please raise your virtual hand.
Now the journalists are going to ask some questions.
I call you. We consult if you regarding how to answer updates. The countries that will reach out to Reuters.
Now Reuters is asking a question, the agency.
Andrea, we cannot hear you. Okay, so Andrea, I think that you froze, and sometimes I see, or Andrea, can we hear you now?
I don't know, can you?
Yes, now we can hear you loud and clear, so please go ahead.
I'm so sorry, I was asking about the de-anchored inflation.
Oh,
Somebody muted Andrea. Somebody.
Should we try again? Sorry.
Yes, let's try again. Technology is not our friend for the start of the year. Let's go ahead.
Okay. So I was asking about the sentence in the report that talks about the possibility of de-anchored inflation expectations. And I wonder if you could walk us through that and what your sense is of that, given all of these other risks that you've outlined, ranging from tariffs to sort of longer for higher interest rates. And then separately, I just wanted to ask about the notion that you've got about the dollar and the stronger dollar and what's happening with the dollar now and how you see that playing out, given all of the sort of warnings in there about trade and isolationism or protectionism and trade measures. Thanks.
Thank you, Andrea. So on the de-anchoring inflation expectations, let me start by taking a step back and reminding everyone one of the great achievements in that inflation episode we're just coming out of is the fact that inflation expectations remained very well anchored in most countries in the world.
And I mean, anchored means they stick to the expectations of the central bank, long-term expectations. I mean, the expectations of people or investors or the market participants or businesses in many countries, he's arguing, is well anchored, meaning that they did not really skyrocket, even if inflation has skyrocketed. Okay, that's what he means by that.
And as a result, this helped the disinflation.
Of course, this is very much in contrary with what has happened in Turkey as well as what is currently happening in Turkey, because household and business expectations are off the charts in our lonely and beautiful country.
Proceed fairly quickly and aggressively. And so central banks were able to rely on the credibility that they had accumulated over the years and convince households and businesses that they would not let inflation run away. And that really helped contain inflation pressures. Now, the danger is some of that capital may have been eroded, if you want, that credibility capital may have been eroded. And if we were to have a new sequence of increase in price pressures, which, again, as I explained, is not part of our baseline, it's under some of the risks that would be associated with maybe some expansionary policies in some part of the world or some supply constraining policies, then that capital may be eroded. And as a result, households, people, businesses may be very, very cautious and very reactive in adjusting their prices and their inflation expectations going forward. That would make the task of central banks much more difficult. On your second point on the stronger dollar, if you have a combination of policies that leads to stronger activity and a resurgence of price pressures in the US and leads the Federal Reserve and maybe other central banks to delay their easing cycle, then that will attract foreign capital, that will strengthen the dollar, and that will, in doing so, that will put pressure on the rest of the world. Many countries, especially emerging market economies, but we see that elsewhere, have imported goods that are priced or invoiced in dollars. A stronger dollar means higher prices for these goods. It means higher domestic inflation pressures.
Okay. I was going to call before the FT, so please go ahead.
Hi, I'm Amy Williams for the FT. You mentioned the dangers of an excessive rollback in regulations. I wondered if you could get into some specifics about which regulations are top of mind here for you. And then secondly, on monetary policy divergence, wondering how you think the ECB should respond if it cuts short-term rates, but longer-term yields rise because of movements in US treasuries. Do you think that ECB should restart QE to control longer-term rates? Thanks.
Yes, thank you. So on your first question, I mean, there is a sense in which in the US, one of the risks that we describe, one of the change in policy that could happen is some move towards some amount of deregulation. Now, it's certainly the case that some regulations can be eased and would favor higher growth rates. You can think about issues in terms of permitting or other things like that. One concern is, in particular, if you have certain regulations that are designed to contain risks, and in particular, risks in the financial sector. And you could imagine that deregulation in that area, if it is excessive, and I'm not saying it is, I'm just saying that this is one of the risks that we describe, could lead to a buildup in financial vulnerabilities and an increase in leverage in the economy, and eventually a correction. So we would have something that we would describe as the risk of a boom-bust dynamics. Now, on the euro area, and you point out the fact that the ECB is projected to continue cutting rates, and that's also in our projections. But we have seen, both in the euro area, but also elsewhere, we've seen this tension between policy rates coming down and the yield or the funding costs for governments, the long-term yields going up. That is a concern because if the economy slows down and the central bank needs to ease further, it gets back closer to what the situation we had in the 2010s, which is interest rates could be constrained because central banks cannot go easily below zero, what we call the zero lower bound. Typically, in an environment like this, you would say, well, maybe if the economy needs to be stimulated, you could rely more on fiscal policy. But if long-term interest rates remain high, then you don't have much fiscal space. If you have low growth, high interest rates environment, you don't have much fiscal space. And that's a worry that we have when we're looking at some regions of the world. You could have this combination of exhausting the monetary policy space and having very little on the fiscal side. And then at that point, it becomes much more challenging to implement stabilization policies.
Okay, so let me just, not go into the details of the presentation, but I think you got the point. So when they do publish the reports, even for the update, they basically make presentations, very detailed and lengthy presentations about the content of the reports. And actually, for the full reports, they even do it, in a more detailed way. They do actually multiple presentations. Because in the full report, they have the chapters, and for each chapter, they do a panel talk, because each chapter is written by a different set of economists, and the economists that contributed to each chapter, they come together and discuss the contents of the chapter, as well as also then answer questions from the audience, which are only, as you can see, journalists from different news agencies or newspapers or TV channels. They ask questions about the content of the chapter. Okay, so I think